Hello everyone, this is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, December 15th, 2025. In terms of economic data, we still have a bit of a hangover from the government shutdown, which continues to cause backup in terms of data that's been released, and particularly for this coming week. But in terms of economic releases last week, we just had 2 items and then one big development, which was the FOMC, Federal Open Market Committee, decision on Wednesday. But the 2 data points on Tuesday, we had the JOLTS job opening. Again, this is not often, a market moving event. However, the September number, late reporting again because of the government shutdown, but the September number was much better than expected. So the consensus was 7.2 million open jobs. Total was over 7.6 million. So that was a good data point. And then the opposite on Thursday, initial jobless claims. Now you may recall last week we had what looked like an outlier. Expectations were 230,000 new job claims, unemployment claims, and it came in at 216. So a bit of a surprise. This week went the other way. The expectation is we'd have 220,000 new claims. Came in on the high side, 236. Between the 2 weeks, probably not much information. So the big event last week, though, the Fed Open Market Committee and the discussion of the economy on Wednesday. Yes, the Federal Reserve did cut their discount rate 25 basis points. The range is now 3.5, 3.75. That's the 3rd cut of the year. There was no surprise. It was completely priced into the futures market. But as we discussed last week, it's rarely what the decision is, it's the rationale for it. So we'll just talk a little bit about what Chairman Powell had discussed during the press conference after the meeting. So to begin with, he rationalized the 25 basis point cut really because of weakness in the labor market. Again, without these updated metrics that we have not been seen because of the government shutdown. We're not really sure what they are, but it does certainly feel like there is labor market weakness. We just can't quantify it. Some of the other discussion points were the Fed really is going to take a wait-and-see stance going forward. So while the market was expecting 2 rate cuts next year, Federal Reserve stuck to a dot plot which shows only 1 cut next year. So you would expect the futures market to change and for investors to price in only the 1, but as of this morning, there's still 2 priced in by the end of 2026. Some of the other things that were mentioned in terms of inflation, Powell mentioned that inflation measured by PCE is still elevated. Too elevated, whatever the terminology was. So that's at 2.8. We're going to, as you'll see in a moment, get another inflation read this week, updated hopefully, and see what that looks like. But in terms of tempering expectations for future rate cuts, certainly Powell cited the fact that inflation is not where the Federal Reserve wants it to be. In terms of economic growth, however, the Fed had increased their expectation of GDP growth for 2026. Back in September, they stuck to that. So the expectation is 2.3% real GDP growth this year. So no change there. But Powell, on another matter, did mention that housing weakness in the U.S. has continued. So housing market still under some duress. Lastly, on the committee, that was not a unanimous vote. They aren't always, but this one is kind of notable. You had 1 dissenting vote that wanted 50 basis point cuts versus 25. Then you had 2 major voters, headline names, that argued the opposite, that there was no need for a cut at this point. So we have not seen our 3rd quarter GDP growth number yet. I think next week that should be announced. The Federal Reserve, the Atlanta Federal Reserve, slightly ticked up their estimate to 3.6% from 3.5 the week before. Not a lot of news there. No news here whatsoever in terms of inflation expectations. The 10-year break-even analysis still shows the expectation for average inflation over the next 10 years of 2.26%. Lastly, in terms of last week, I just mentioned the Fed funds future market, the fact that they have priced in 2 rate cuts, slightly more likely than not next year. But in terms of the January Federal Reserve meeting, there are very low odds of a cut, of one cut. There's a 27% probability built into the futures market. So last week with that Fed information given and really not much else from an economic standpoint, markets down a little bit. Equity market, S&P 500 for sure down 60 basis points. But in an odd twist, the equal-weighted S&P, which is almost always underperformed the S&P 500, certainly since 2022, that actually outperformed significantly. It was up 76 basis points. The reason why, the Magnificent Seven down last week. In fact, NASDAQ last week down 1.6%, and a rotation further to value and small cap. So last week, growth was down 1.12%, value was up 1.2%, and small cap outperformed last week, up nearly 1%, and large cap was down 90 basis points. So on a year-to-date basis, S&P 500 now up 17.5% as of the end of the day Friday. And in, again, another twist that is sort of, I think, underreported, value has outperformed this year. Value up 17.6%, growth up 14.2%. Large versus small, still an advantage to large, but that gap has been decreasing over the last 2 months. In terms of international markets, they were up a little better. Well, they were up last week, so they were up better than the S&P 500. Both developed markets and emerging markets positive, and both of those indexes are significantly higher than the S&P 500 this week. The developed market index up 30%, emerging market up over 32%. In terms of fixed income, both the 2-year and the 10-year were up 4 basis points, so slight weakness in the bond market. The Bloomberg U.S. Aggregate Bond Index down about 30 basis points last week. So this week, it looks like we're going to get a real catch-up here on a lot of economic activity. Now, we don't have great clarity on exactly what is being reported. The big metric in a day to do it, tomorrow, Tuesday, we're going to get non-farm payroll numbers. Now, normally we get that on a Friday. Not only are we getting it on a Tuesday, but we're getting a consolidated October and November, I think. Not entirely sure. But the number, consensus expectation, is an additional 30,000 jobs. The last real number that we had, September, was, probably may recall, was upside surprise at 116,000 new jobs. So also tomorrow we're going to get retail sales ex-auto, both of those metrics pretty much in line with what we saw in September. Now these are going to be October numbers, and both are expected retail sales and retail sales ex-auto up 30 basis points. Tomorrow we'll also get the unemployment rate. That's expected to be at 4.4%. I believe that's where we were at in September. And average hourly earnings back in September were a positive 0.2% month over month. And for the month of November, it's expected to be up a positive 0.3%. Thursday, we'll get core inflation, CPI and core inflation. Both of those are expected to be up 0.3%. Again, we don't have October numbers, and so I don't even know what to compare them to. September numbers, I'm not sure. But again, inflation headline and core CPI up 0.3% month over month. Also on Thursday, we're going to get initial jobless claims. Expectations for this week are 225,000. As we mentioned a little earlier, we had a negative surprise last week as it came in at 236,000. Lastly, on Friday, we'll get existing home sales. This is an updated number. It'll be for November, and the expectation is 4.14 million existing home sales in the month of November, which is what we had back in September. So that's a recap of the economic data and how the markets reacted last week. We thank you very much for attending, and we'll look forward to seeing you next week. Thank you.